This week, what group of retirees may be the most overlooked when it comes to a reverse mortgage? And what retirement challenges could a HECM help solve? The answers, they may surprise you. We'll explain right after this short message from our sponsor, Liberty Reverse.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back, and thank you for joining us. One of the most interesting stories I came across this week appeared in Kiplinger, and it takes a closer look at something that most reverse mortgage professionals understand very well, but much of the financial planning community is only just beginning to understand. The article was written by Jerry Golden, president of Golden Retirement Advisors. Golden brings an interesting background to the discussion. In fact, before becoming a financial advisor, he spent years working as an actuary, designing lifetime annuity products in the insurance industry. In other words, his career has focused on one core question: how do you create income that will last for life? And that experience is what led him to a growing conclusion. Many traditional retirement plans are missing one of the most important elements of all: liquidity. Liquidity simply means access to cash when you actually need it. Golden points out that many retirees today look wealthy on paper. They may have retirement accounts, investment portfolios, and real estate, and even significant home equity. But when large expenses appear, those assets are not always easy nor efficient to access. For example, imagine a retiree suddenly facing long-term care expenses. Today, those costs can easily exceed $400,000 over time. So what are the typical options? One approach is to keep large sums of cash sitting in a bank account, just in case. But that strategy can be extremely inefficient because the money earns very little and it drags down overall returns. Another option is to withdraw large lump sums from an IRA or other tax-deferred accounts. But that approach can trigger significant tax and potentially increase Medicare premiums as well. Now, Golden argues that both strategies are expensive and inflexible. That's what led him to study the home equity conversion mortgage, or the HECM. And as most of you watching know, the HECM is the federally insured reverse mortgage program overseen by HUD. It allows a homeowner age 62 or older to convert a portion of their accumulated home equity into accessible funds while remaining in their home, just as long as they meet the loan terms and stay current on their property taxes and their homeowner's insurance. The loan also includes important consumer protections, including the non-recourse feature. Now, many of you that are unfamiliar with it, it simply means that the heirs or the borrower will never owe more than the home's worth. Now, knowing this, Golden began to look at the way that a HECM could function as a liquidity reserve inside a retirement plan, a valuable tool in retirement income planning. And rather than selling investments during a market downturn or holding large sums of cash idle, a homeowner could establish a HECM line of credit and then draw on it only when it's needed. And that line of credit can be used for unexpected health care costs, home modifications, or long-term care expenses. In other words, the home becomes a source of flexible liquidity without requiring the homeowner to sell the property. Golden emphasizes that the loan is not to replace traditional retirement assets. Instead, the HECM helps solve the liquidity challenge that many retirement plans overlook. But he takes the idea a step further. Golden suggests pairing a HECM with a qualified longevity annuity contract, or what planners call a QLAC. Now, of course, this arrangement would have to abide by HURA regulations, which do prohibit originators from cross-selling financial products. But that said, in Golden's design, the HECM provides flexible income and access to funds during the earlier part of retirement. Meanwhile, the QLAC is structured to begin guaranteeing lifetime income later in life, and that could be in the mid to late 80s. The combination is designed to address two specific retirement risks simultaneously. The HECM provides liquidity and flexibility, and the QLAC provides longevity protection in the later stages of retirement. Golden refers to the strategy as the home equity to income, and he believes it represents a more modern framework for retirement planning. Now, the bigger message here is that retirement planning is beginning to evolve, and it's no longer just about building the largest possible investment portfolio. Instead, planners are beginning to increasingly focus on how to combine the multiple assets and also include investment accounts, annuities, Social Security, and home equity to help create reliable income and financial flexibility throughout retirement. And that is where the reverse mortgage in the conversation does continue to expand. I know we're still wanting to grow more, but before we continue, I have a quick disclosure to our viewers who are homeowners or maybe seeking financial advice. I am not a financial advisor. I'm a reverse mortgage commentator, trainer, and also a passionate supporter of the proper use of reverse mortgages. So always seek the advice of a trusted financial professional when you are considering a reverse mortgage or any investment. Now, for many retirees, the home may be their largest asset, but historically, it has been treated as something that just sits on the balance sheet. Articles like this do suggest that more financial advisors are now beginning to see home equity for what it really is, a potentially powerful retirement planning tool when it's used correctly. And that is something reverse mortgage professionals have been saying for years. What are your thoughts? You can leave those in the comment section below. And if you found value in today's post, if you would consider posting it to your LinkedIn network, we do appreciate that. We have a YouTube channel as well. You can subscribe. That way you never miss any of our latest content. And each and every week, reverse mortgage professionals and mortgage professionals, for that matter, can catch up on the latest reverse mortgage related stories on our weekly podcast. That's HECMWorld Weekly. We have both an audio and a video edition. Listeners can listen and subscribe on iTunes, Apple Music now, and Spotify. That's a wrap for us here at HECMWorld, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find right here at HECMWorld. Have a great week.